The primary purpose of this podcast is to educate and inform. The views, information, or opinions expressed by hosts or guests are their own. Neither the show nor any of its content should be construed as investment advice or as a recommendation to buy or sell any particular security. Security-specific information shared on this podcast should not be relied upon as a basis for your own investment decisions. Be sure to do your own research. The podcast hosts and participants may have a position in the securities mentioned personally through sub-accounts and or through separate funds and may change their holdings at any time.
Welcome to This Week in Intelligent Investing, where we examine timely and timeless investing topics to help you become a better investor. Enjoy authentic, unscripted discussion featuring Phil Ordway, Elliot Turner, and other thought-leading investors, brought to you by MOI Global. And now, here's your host, John Mihaljevic.
Welcome, everybody, to a new episode of This Week in Intelligent Investing. Great to have you with us, and great to welcome my co-hosts as well, Phil Ordway and Elliot Turner. We have a great discussion ahead. Over to you, Phil.
Thanks, John. So I thought this week we'd talk about something that I've kind of smirked at over the years as it periodically resurfaces is a great debate among the pundit class. And so I went back. There was an article last week. It ran March 5th, 2023 in the Wall Street Journal that said, Wall Street concedes there is finally an alternative to stocks. And, it goes on to talk about Terra, which is there are reasonable alternatives. Tapas, which is, I forget what that one stands for. Tiara, which is there is a reasonable alternative, all this nonsense, right? And I actually went back and then searched the archives, and it's hilarious to watch this stuff, right? Because I think Tina first came into the zeitgeist, I don't know, what do you guys think, a decade ago? I didn't go all the way back to find that, but it's been a powerful, kind of thought process or even algorithm for a lot of investors ever since the financial crisis when zero interest rates came to the forefront. And just in the past couple of years, there's been, as with so much else in the world, just a massive whipsaw in sentiment. I mean, as recently as September 29th of 2021, headline in the Wall Street Journal, there is still no alternative for investors. And then 7 short months later, in early 2022, spring of 2022, why investors are spurning Tina and finding alternatives to stocks. So we went from there's still no alternative to now there's definitely an alternative. And then for the last 8 or 9 or 10 months, there's just been a litany of articles and pundits wagging their tongues about how Tina is finally over, and now there really are alternatives to stocks, and what are the implications to all this? No one seems to, of course, have a real answer to that because there is no clear right answer, but it's worth reviewing the facts, right? Because for a long, long time, zero interest rates, if you go back, I'm not one of these Fed haters who thinks that the central bank is the root of all evil and they've completely screwed up and they're incompetent morons who've misjudged this from the very beginning. But if you go back to what it originally set out to do, you could argue it was a success because it pushed people out on the risk curve, right? It wanted to encourage economic activity and by doing so, encouraging, more risk-taking behavior, and more speculative behavior was just kind of a byproduct of that we were all going to have to live with. And, look, that it becomes a rational thing. I mean, when you literally can't make any return in bonds and you're guaranteed to lose money, sometimes even in nominal terms, but definitely in real terms, why would you own bonds, right? There really wasn't much of an alternative for people to own that stuff. And that's why I'd always get these questions from friends or families or people facing retirement or whatever. Like, what do I do? I'm like, well, I'm really sorry. I wish I could give you a great answer here, but there really isn't one. But fast forward to today, one of the byproducts of the big increase in interest rates we've seen over the last several quarters is that there is somewhat of an alternative. You now have, I was just looking at the yield curve this morning, 5% nominal yields in U.S. Treasuries on the front end of the curve. And it's obviously still somewhat inverted. The 10 years down a little below 4%. But, there are muni bond funds now yielding 3.5%, 4%, 5%, even depending on how much duration you want to take with, bargain basement expense ratios. And those are after-tax yields. And that finally does present a little bit of an alternative. As a brief aside, I would say that many corporates are maybe not quite so attractive. We have a lot higher yields in many cases, but if you look at spreads, they really haven't changed. And ironically enough, some spreads have actually come in, particularly amongst either really high quality investment grade issuers or some of the speculative grade issuers, spreads have actually narrowed, believe it or not. So I don't think there's any argument to be made that the bond market is, blown out spreads and things are really juicy and attractive right there. And it's interesting to see that the bond market is kind of calling the Fed's bluff, because it's one thing for the equity market to do it, but in my opinion, it's a much more powerful indicator when the bond market does it. And you look at kind of the forward curve, the futures levels for interest rates, and it's pretty stark. But anyway, you go back to the S&P 500, and the dividend yield today is still actually pretty unattractive in my opinion. It's a little below 2% right now, which is, a pretty historically average level. You look at just simple price to earnings, and on a trailing and forward basis, I mean, you're still kind of in the high teens area at best, which is, historically not been any great shakes. Again, this is all predicated on what interest rates do from here. And we've talked about this ad nauseum. I don't have a great answer to that. But if we take this, I guess supposition number one that I would make is that if zero interest rates and the TINA world that we live in has led to a misallocation of capital in many asset classes, has led to some crazy valuations that have manifested themselves in many asset classes. If that period is now over, now what? And this is what I want to get your opinions on. My answer to that preliminarily would be that starting at the top, venture capital valuations need to come way down, like way, way down. So speculative stuff where the discount rate just mechanically, right? The value has to come way down if the discount rate has changed by this much, right? That's just kind of goes without saying. Next would be private equity valuations where, a dirt cost cheap of debt financing was driving all the value. Mechanically, that has to come down, right? And then next in line would be higher growth equities where, again, kind of a hybrid of the two, like just the cost of capital issue. It's pretty clear. It's pretty mechanical. Valuations have to come down. Another area of risk that's kind of dangerous, and I think you're just starting to see this, would be people that really stretched for dividend yield, where the dividend yield was supposedly safe, but it really wasn't. And anybody should have been able to see that. But everybody's saying, ooh, look at this, a 4 or 5, 6% dividend yield. Like, I'm going to buy this equity. And then you wake up one day and the dividend gets chopped and the stock's down 40%, and you've evaporated any hope of ever making any good, decent return on that. So the other supposition I would have is that bonds may or may not provide any shelter from here. And this is where it gets really, really tricky, right? Because if you really believed in this new narrative and you had a lot of conviction on it, there's a couple of ways you could go. And the market is really saying, you're kind of in purgatory. Like there's not a clear answer on this. So by no stretch of the imagination would I want to sit here and be like, okay, we're definitely going back to super low rates. I want to lock in as many of these coupons as I can today. That seems a little crazy to me. There is definitely a scenario where the Fed has to continue raising to where the economy defies prediction, and you're going to be looking at this saying, boy, I wish I hadn't taken so much risk, so much duration chasing these yields and bonds. And by the way, just as a humorous side note, as I was researching some of these Wall Street Journal headlines, June 30th of 2022, 90% of investors expect a U.S. recession before the end of fiscal 2023, Wall Street Journal headline. December 5th, 2022, 90% of investors expect a U.S. recession before the end of fiscal 2023. Just a couple of weeks ago, 90% of investors expect a U.S. recession before the end of fiscal 2023. So, people have had this thesis and been very, I would say 90% of people believing one thing always makes you want to take the other side of it. And sure enough, they've been waiting for Godot for at least that 7, 8, 9 month period. And here we are, the second week of March, 2023, like the end of 2023 is going to be here before we know it. And if we don't get a recession, these are going to prove wrong. And so what do you do with it, right? I mean, I guess my answer would be, for the first time ever, you have the ability to lock up some money in my opinion, the most favorable area of the short end of the curve, right? You're taking 3, 6, 12-month risk and you're getting paid 5%. And you hope that at least preserves your purchasing power. Because if you just sit in cash for that period, you're going to lose some of that purchasing power. That's about all I can say that's definitively good or attractive. The only other thing that I would say is that, and I've been harping on this, we've all been harping on this to a certain degree, is that if you are a company or any sort of commercial venture and you didn't make money, or if you burned cash over the last, call it 5 years or 10 years, especially in that environment, it just seems really tough that you're going to suddenly thrive in this new environment. Because again, I obviously could be wrong about this, but I think it's really, really hard to make the case that we're going to go back to a zero interest rate world, or a world with lots of negative nominal yields and negative real returns. That seems very unlikely. Certainly the bond market could be correct, and the Fed's eventually going to have to take its foot off the gas or even cut a little bit. But are we really going to go back to Fed funds, at the zero bound and the 10-year at 1.5% or 1% or something crazy like that? It seems very, very unlikely. And so if you are a company that was relying on that, I think you need to be really re-examining life. So I'll stop there. I want to hear what you guys have to say on this.
I think this is an awesome topic, especially today. We're recording this on March 9th, 2023, and Silicon Valley Bank is getting absolutely decimated. And Tina directly, I think, relates to the problems the company is experiencing, where deposits are down year over year, partly because of what's happening in the venture world, but also partly because, much like how at Chase, they're paying me 0.25%. I start asking myself, and by the way, this is not investment advice, let's be clear here, what should I do with my money that's at Chase? Well, I moved it to money markets that pay me over 4% more than what Chase is paying me. So for some of these banks that are relying on people staying blind to interest, and to be fair, again, my whole working career from the day I first had a job, rates have basically been zero. So you haven't had to think about these things. So maybe some people are not processing it properly. I think that's a real problem. And that's something where, as people find alternatives, there's also a whole class of retirees who, if you told them they could guarantee, 4 to 5% for a pretty long period of time, they'd say, equities aren't for me. I'd rather be somewhere else.
For sure.
And that creates selling pressure for equities and buying pressure. And I do think in the insurance world, pension world, there are some structural reasons with how their accounting has evolved over the last decade. And I think this relates to your point on spreads, Phil, where they basically just hoover up some of these yields that are available now because they could accomplish their entire goals by taking far less risk than they'd taken this past decade. That's a massive change. And some of them are going to end up overfunded because they're able to get more yield than they'd priced their expectation to. I think that's a big deal. And it's funny that you called out this recession being like waiting for Godot, because Wall Street Journal just this week had an article that called it the waiting for Godot recession.
Yeah, I saw that too. Yeah, which is funny because they've been, and look, they're just publishing what people are thinking, right? But that's been the popular thought for, like I said, 8 or 9 months at least, right? So here we are.
Yep, here we are, right? And I think it's that how do you go bankrupt? 2 ways: gradually, then suddenly. It's like gradually, then suddenly, people are coming to the realization about the consequences of higher rates. And I think part of that realization was not just rates going higher, but now the acceptance that they will be higher for longer than we'd previously thought. And so you ask, now what? It's hard to disagree with valuations. I think a lot of that we've seen play out as we've had this reset. I think you have less activity in areas of the economy that are rate sensitive. So obviously that means home sales are lower, auto sales definitely get impacted. The areas where rates were important in driving economic demand, the calculus has changed. So even beyond inflation, in some of these areas, rates will have a bigger impact than will inflation itself in driving cost. And there's a degree to which that makes inflation reflexive, but that's a different story in some ways. I think something like BNPL, right, where it was economically attractive to charge merchants double the discount rate in order to get them paid on some demand that wasn't double the merchant discount rate, not the financial discount rate. they're paying like 4% to Afterpay versus 2 and change to someone like First Data. It's a pretty big difference being in a 4% interest rate environment where you're footing effectively, it's a negative float business. It's a high working capital business, not negative float. The calculus of that gets pretty damn tough for a pure play BNPL who doesn't have any offset on the funding side where they could actually earn some money from higher interest rates. I think there were a lot of people who bought staple stocks for dividends over the last decade. A lot of people talk about the valuation reset over the last year. I just mentioned it myself. One thing that hasn't reset are valuations in staples. And I think part of what fueled that in the beginning was you could buy some of these really sleepy, slow growth company for better yields than the 10-year. And hey, you're going to get some growth. Maybe not a lot, but you'll get some growth. So you're going to win versus 10-year no matter what happens. And then what fueled them last year was, oh my God, we might have a recession. So I need to buy these staples because they're theoretically safe. But then when you reflect on it, as far as I'm concerned, some of the most expensive stocks in the world right now are these staples, far more so than the growthier companies. And I do think actually, I Phil and I have kind of had a slightly different perspective on this for a while now, but I do think that changing interest rate environment does make some of these companies who are growth at all costs realize, hey, we need to deliver profitability now. And I could, there are a lot of anecdotes, but there are a lot of companies who are like, yeah, we're changing. We realize that we can't just keep doing what we've done, and the regime's different. So I think that's pretty real. I think companies are going to be geared differently right now. And then the last one I'd offer is there are some companies who'd been holding a lot of cash for whatever reason. And some of these companies are actually going to make more money from interest than from their business. And so there could be some funny setups out there in that sense. So those are some things that come to mind.
Before I forget, we were talking about this offline before we started recording, and it's worth revisiting it now as a good example of some of the unintended consequences that I think you're likely to see, and why I think it's easier. I guess this is kind of my philosophy on life and my philosophy in investing in general, but it's easier to see the mistakes and avoid the landmines than it is to predict any path to victory. But if you can avoid this kind of stuff, you're way ahead of the game. So we were just talking about one of the big stories in the news lately, which is Silicon Valley Bank, which for anyone who doesn't know is a pretty well-known but kind of niche, a little bit of a different animal in the banking world, as the name implies. A California-based bank that's been well-known and has been well-established within the tech world for many, many years. I first came across them when at an old firm of mine way back ago, a long time ago, we used to kind of compete with them in underwriting kind of secured debt, where they would come in and just literally take a first lien on everything at a tech company that was reasonably well-established, but maybe not cash flowing as you would normally need it to be. And they would take a first lien on, everything from the physical assets of the company to the office furniture. And then they'd get a bunch of warrants and they'd kind of clean up on that basis 1 out of every 50 times. And the overall ROE kind of worked. And anyway, what they've done in the past number of years, I actually don't know when exactly this started, but they built up a truly massive fixed income portfolio where they had a huge book of both held to maturity and available for sale securities, lots of mortgages, lots of things with both fixed and floating rate that particularly, obviously, as rates shot up last year, the fixed rate stuff is being carried now at a massive unrealized loss. And just yesterday, I think it was after the close yesterday, they announced that they were basically punting their entire available for sale book and taking, I think it was a $1.6 billion loss on that portfolio. It was a very sizable loss, and raising some very expensive, painful dilutive equity to do it. And the stock got absolutely smoked. As of right now, let's see, it just was halted a second ago. So the stock was flirting with $100 a share. And, to put that in context, about this same time a year ago, the stock was at $600 a share. So this is kind of a disaster, right, for anybody that's been riding that dragon, so to speak, for the last 12 months at least. So that's the kind of stuff where, like, look, I don't, and this is not investment advice by any stretch of the imagination. I'm not super close to Silicon Valley Bank to have a firm opinion on it either way. But I think it's safe to be said that some capital was seriously misallocated there, and that the company will be working their way out from underneath this massive headache for quite some period of time, right? And you want to avoid that at all, if at all possible.
And it's interesting to think about how this relates to TINA and where rates are, because already today you're seeing a little bit of repricing of expectation on rates. Like, does the Fed really want to break things hard, or do they want to like slow things down? You get to finally have that conversation.
Yeah, and look, I haven't spoken to Silicon Valley Bank management in a long, long time, but the stock's basically back to where it was 7 or 8 years ago, call it, and that could have been. I mean, if you want to just go on circumstantial evidence, that could be roughly around the time that a lot of bank management teams said, wow, we're still stuck in this zero interest rate world. Like, where are we going to generate the interest income if we don't have the loan portfolio to do it? How are we going to generate spread, right? Every bank has to generate spread. Where are we going to do it? And if then or in subsequent years, they decided like, yeah, we're going to have to creep out the risk curve and either do it in fixed income securities with a lot more duration than we normally would, or whatever. Those are the pressures that every business, that every management team faces from time to time. And if you get those big decisions wrong, this is the kind of result that you have, where the stock's down, whatever it is, 50, 60% in one day, and it's down 80 or 85% from its peak 12 months ago, this kind of stuff, right? It's really, really painful.
Well, yeah, this relates to the deposit point, right? Their deposits had ballooned over the last 3 years. Some of it fueled by the environment generally. So that happened at a bunch of banks, but some of it fueled by what happened in VC in Silicon Valley in particular.
Yeah, you're right.
And you could kind of see the connection between them. I was just looking. I really did not have Silicon Valley Bank on my radar until this morning. So let's put that in context. But they if I reason out what happened, what I saw on their balance sheet, it's like they're like, well, we have a ton of deposits. What should we do with it? Well, we'll buy really low yielding mortgages.
Yeah, right. Yeah, to your point. And so again, like, I don't have any position here as usual. I'm not talking my own book. I have no investment advice to offer here. A friend of mine who runs his own fund has been short this for a while. So I've talked to him about it on kind of a friend to friend or advisory basis, because he knows that I think banks are interesting. And my advice to him always was like, yeah, there's a problem here, but that doesn't necessarily make it a great short. Of course, it did turn into a great short, and we could talk about why that is. But yeah, it is pretty stunning. I pulled up the numbers here, just to your point, Elliot. So deposits at the end of 2019, right as we're going into COVID, were just under 62 billion. And 8 quarters later, at the end of 2021, they had more than tripled to 189 billion. So, I mean, that is an issue, right? Like, if you don't put that capital to work, like, you're going to bleed your ratios down a lot, and you're going to be a lot less profitable than you otherwise would. I mean, it's a problem. Like, you're between a rock and a hard place in a lot of cases. If you're one of these management teams, like, I don't envy them at all.
So what do you guys, think in terms of opportunities in other asset classes? Phil, you touched on fixed income here, but what about, real estate, commodities? Is that on your radar at all? And of course, those kinds of bets can be expressed through equities as well.
Sure. Yeah. I mean, I think Elliot made a good point, which is that for a long, long time, if you were reasonably secure, or even just, kind of a typical upper income saver for retirement, if you reached a certain age or a certain income profile, you'd say, all right, I'm going to sock a huge chunk of my portfolio away in decent yielding, highly rated, stable, secure municipal bonds, right? And I'm going to make 4, 5, 6% after tax, and I'm going to live off of that. And, as long as there aren't some disastrous credit mistakes in there, like that, it's a reasonably assured return, and life's going to be okay, and I'm going to live off of that, and everything will be good. And, you might have 20, 40, 50 or 60% of your portfolio and that kind of thing, depending on your profile and your risk tolerances, right? And for the last many number of years, that just really didn't make a lot of sense or wasn't even possible or feasible. Now that's becoming more feasible again. So, you can get to a point where people would and should do that. Again, not investment advice for me, but it would make total sense for people to be looking at that kind of stuff. I am definitely not a commodities expert. I'll beg off of that one. I don't think real estate and infrastructure really fall into my area very much either, but I will say that some people that I know that are good and do know their stuff and are very well respected would probably make the same argument that I just did about the other asset classes. Is you kind of come down the curve from crazy to less crazy. You either need to really readjust and take a big haircut to the valuations that you've been carrying on the book, or you need to take a small one. But in no case have I seen like, wow, these are just some crazy once a decade or once a generation valuations that are being floated around out there because everybody had this big freak out to interest rates. If anything, I think we're still kind of in the middle of that readjustment period.
I mean, there are some, equities that are pretty beaten down, let's say in the commercial real estate space, New York City, Vornado. Obviously, there's a short thesis on that out there, but you look at kind of how they've done over a long period of time, created a lot of value. And, it's kind of interesting because if inflation is going to be here to stay, we all know real estate benefits from that. Not necessarily commercial, but let's just say real estate in general. But we're kind of in this transition phase where, we have the shock of higher interest rates. And so all of these companies have been hit. Even you take a residential real estate giant in Germany called Vonovia that owns like 500,000 apartments in Germany, trades at a huge discount to NAV. So there you don't have that commercial real estate tailwind going against it, which I think makes it kind of interesting. But again, we're in this transition phase where all of these companies have been hit because their balance sheets were built in a low interest rate environment, and they're going to need some time to readjust their balance sheets. And some of them will probably go bust. But, you could say that the leaders that are conservatively financed are going to be fine, and they're going to benefit. So, maybe an area to look at where you can actually get a discount in the equity market looking at real estate as opposed to direct investments in real estate.
Yeah, I think it's a really interesting thought, especially, you mentioned like Vornado, New York City, the New York City real estate environment. Vornado is like heavily levered to office space in particular. They were already facing questions about what work from home would do to them. And you're getting some progress on that front right as you get the headwind of interest rates. And so anyone who had a thesis on inevitability of back to office is getting hurt from something different arising. So it does seem like a situation where a lot of towels are being thrown in and people are moving to the side. Now, this is not a, recommendation for the stock, but I find that area interesting, especially because, I've spoken to some sharp real estate people and they're like, these things are definitely below NAV. Some of them could shrink their portfolios and sell some properties and start repurchasing their shares. It's a very different playbook than had been at work in the recent past. And so I think part of it is, understanding management's incentives and their intents and what they're going to do around it. But these are questions I'd been asking myself and some areas I'd been poking around just to get a sense of what is or is not there.
Yeah, it's interesting. Do you know, I'll just profess innocence here because I've always considered myself a total tourist in real estate related stuff. If I were to draw the analogy between, we talked about this a little, maybe a month or two ago, that for the first time in like 20 years, there were more retail brick and mortar establishments opened than closed, right? Because for like 15 years or something, you were working off the excess, right? We were overbuilt. There was too much retail square footage and we were overbuilt. And maybe now you've finally gotten to the other end of that rainbow. Was that how did that play out? And obviously you have this massive monkey in the room that, the interest rates were declining that whole period. And now maybe they're going up for the next 15-year period. But I don't know, it would seem shocking to me if we were really actually below what a new cash buyer would say is stated NAV for some of these office focused funds and properties. Am I wrong?
I don't want to answer too strongly because I'm speaking from a position of naivety, but SL Green's trading at I believe it's like half of their book value. So it's a little different than the overbuilding of commercial because they're heavily situated in the like Grand Central proximity of Manhattan, even like the areas where property is scarce. And there are theoretically alternative uses that some of these buildings could be repurposed for. So I don't know. It's just a thought I've had, but I think that's a little different than the overstoring of America.
Oh, it's definitely different. No, 100%. I'm just trying to make a crude analogy of it's sort of like Silicon Valley Bank. Like my working thesis, very loosely held, would be, this is a real bank with a real reason to exist and a real franchise, but they're going to have a multi-year slog to kind of work their way out from underneath the overhang of this disastrous, securities portfolio. And it's sort of like, all right, if you built a bunch of office space, a bunch of commercial real estate projects in the last 3 to 5 years under the assumptions of zero interest rates in the pre-COVID workforce, that is also going to be a multi-year slog to get out from underneath that.
Yep. No, I tend to agree. I mean, I live here in Stamford where we have the highest office vacancy rate, I think, well, at least for long periods of time in the country. And it was partly because they'd built these sprawling suburban campuses that housed, large corporates, from GE to, Priceline had their headquarters here at one point.
UBS,
a bunch of corporate Frontier. Yeah. There were a bunch of companies in these, and it was a combination of they didn't want to be in these kinds of locations anymore, and they can't really decide on how to repurpose that land because you had one large tenant, but you're not going to get once they leave, you're not going to be able to rent like one space at a time and get people excited about picking it up. So you need someone big to come in,
right? But
I think downtown Manhattan, business district kind of areas is a very different beast, where there are a lot of structural reasons that property will have value for office space for one way or another, so long as you believe that people are still going to be working from an office.
Yeah, but, we've had that debate and it's fascinating, and I'm not trying to relitigate that. And I'm at the other end of the spectrum from some of these fear-mongering types that are like, New York or every big city is just like an urban hellscape and it's all crime and no one wants to be there anymore. Like that's just so blatantly false. And it's just kind of sad to watch these people self-justify their prior decisions or whatever their existing biases are. It's just really odd. But anyway, that said, I think it goes without saying that there are a lot of real estate projects that were done under assumptions that no longer hold. And so I just think it's going to be interesting to see how those get worked out. And look, the real estate industry is notorious for solving exactly those problems. Sometimes it's painful. They often get overextended, but they find a way, just like, the American business writ large. There's actually a fascinating article a couple of weeks ago in the FT. I'll send it around in the link. I'll link to it in the notes with this podcast about the number of commercial buildings in Manhattan that are being repurposed to residential, which is really interesting. And there's a lot of issues that I'd never considered there, such as I think the average depth from the window to like the central core to like the elevator shaft in your average residential building, you'd only want like 30 feet because you don't want to be too far away from the windows, right? You want lots of natural light in your living space. But in an office floor plate, it's like 45 feet. So like, how do you solve that issue, right? There's all these interesting things I'd never considered along those lines. But look, I think they'll figure it out. I just think, much like you're saying, and like I just said, that's why Silicon Valley Bank's maybe a good poster child for this. There's going to be some earthquakes here. There's going to be some real adjustments where it is a jolt and a gap down as you find your new footing in this world. And you want to try to avoid having bought Silicon Valley Bank with equity with fresh money last year at $500 or $600 a share, right? Because that's probably gone.
Yeah. And, you talked about these workouts, right? One of my favorite examples in the area is now called the American Dream. It was called Xanadu at one point. It was called the Mall of America at one point. It's just changed hands so many times because like each time a new owner took over, the underwriting assumptions changed and the reasons changed, from, too much debt in the financial crisis to cost overruns on the build out because of how different things were as they got through the project from when they started it. And yeah, I'd imagine there are going to be quite a few of these kinds of problems. I've worried in my own area, like they started building a whole lot of multifamily. And it's like, where are all these people going to come from that are going to rent this? That's COVID kind of helped because I was worried before COVID. So people left the city. Talk about those who are justifying their own personal decisions on the city. But things are always changing. I think it'll be interesting for some of the people who've been holding a lot of cash to try to like capitalize on when this inevitable reset happens. I've spoken to some sharp real estate people and they're like, I mean, maybe they'd change their tune today because I haven't had any of these conversations for a little over a week. That's how quickly things have moved in a week. But, they've been saying stuff like, I expect the opportunities to manifest later in 23 or even into 24, that a lot of people haven't accepted new realities and they haven't been in a point where they felt acute pain to have to change anything. But, maybe we are starting to see some signs of acute pain.
Yeah, I think that's exactly the key point, right? Is I'm shocked that there hasn't been more acute pain. And maybe now we are starting to see it, and time will tell. I could be wrong. Maybe we'll kind of zombie walk our way through this, and there won't be that massive panic freak out reset. It'll be more of like a multi-year grind it out kind of situation. I don't know.
Yeah, I still think part of the I want to say problem, but it's the opposite of a problem. Part of the silver lining is that balance sheets are really good across all private sector subsectors. So if you're talking about financials, if you're talking about households, if you're talking about corporates, balance sheets are really good. Debt's termed out. So companies and, homeowners refinance their balance sheets and have a long time before the debt itself becomes a problem. It's almost like debt is an asset. One of the things that some of these property people have said is there's actually pretty good, the one area of the market that's still transacting pretty well are properties that have long duration debt that's transferable in the event of a sale. And, that liability has turned into an asset of sorts in this environment. And so there's quite a bit of that. Obviously there's certain cases where, if you bought in like 2012, you probably didn't have the opportunity to refi over the last couple of years. And that might be a bit of a cliff, but there's no cliff. And I think that's the real reason why you haven't seen this sort of acute pain. And I guess one of the questions that I'm asking myself today is Silicon Valley Bank a sign of something, or are they an outlier with incredibly unique circumstances getting them to this point?
I would say more outlier than not, because they're a bank, right? I mean, by definition, a bank is going to have more leverage on the books than most companies. But that said, I do think they are symptomatic of the broader environment, and I think there are lessons for other companies and everybody else.
And there's a funding mismatch at work, so you have to be the kind of thing where a funding mismatch becomes your problem. Like we were talking about this before, but they don't have to mark down their held to maturity portfolio. Like in theory, they can see it through.
Right.
But they had a problem on the funding side too. So it's like they're getting squeezed on both sides. That doesn't happen with, the owner of a high quality building who's slapped 10-year debt on it.
Yeah, look, I mean, JP Morgan and B of A and every other bank in the US has a similar unrealized loss in its held to maturity book, right? So this is not unique to Silicon Valley Bank. To your point, and this is a great lesson that applies to all sorts of things, you need 2 or 3 or 4 things to all go wrong at once, right? So JP Morgan and B of A are big, diversified, well-capitalized banks, and they're not overexposed to a massive securities mortgage low rate portfolio that's just crushing them right now because they have other assets on the books and other funding sources and blah blah blah. But the problem is going to be, to your point, if you are an asset liability mismatched financial institution with a relatively high degree of leverage on the books, and then you run into a deposit or a credit problem on top of it, now it's look out below. Or if you're an airline lessor that locked in a bunch of crazy lease rates and there's a huge travel recession next year, that's not going to be great. If you're a commercial real estate developer and people just never come back to work and you've underwritten all these projects at, crazy high occupancy rates that are never going to happen before the interest rates combined with that are going to be a problem.
I'd maybe draw a point of contrast here with the aircraft lessors insofar as, I don't think it's all that shocking where the first big problem in the financial space that we're seeing, or the first two, are a crypto bank and a bank that specializes in exotic Silicon Valley loans.
Well, for sure. Yeah. And you're right.
And
aircraft leasing at the far other end. Yeah.
They went through a period of extreme stress. So I'd imagine they're, positioned for a bit more resiliency. I'm saying, again, from a position of naivety here. No, but I'd imagine there's a little more inherent resilience to those areas that had been very stressed of late versus those that had not been, that had been the exact opposite of stressed of late.
No, you're 100% to clarify. So right now, I mean, because of idiosyncratic issues at Boeing and Airbus, and because travel demand has come roaring back and shows really, as of today, no forward signs of slowing down, the demand for those aircraft is off the charts almost, and the leases they've signed look too cheap, and they could probably reprice them higher today if they could. I'm just saying, if you were over extrapolating low interest rates from 18 months ago and a massive COVID rebound in travel, you still have one of those two working in your favor. And then if that second leg falls away, just like low interest rates did, maybe you have a problem, right? I mean, the lesson here would be something like there were actually these really crazy individual LLCs set up just to lease one-off A380s, the big double-decker jumbo jets produced by Airbus starting about 20 years ago, and they fell out of production, like they're literally no longer being produced, and now they're coming out of storage again, ironically, because the demand is so high. But there were a bunch of them in Germany, there were a few others around the world where they would literally just buy one A380 and lease it to an airline, and you do that as an investment vehicle. And if you were doing that 5 years ago or even 4 years ago, at the assumption of both zero interest rates and perpetual forever demand for the A380, both of those legs are gone from your stool and you're sitting on the floor, right?
Yeah, and I think a couple of years ago, Buffett even called out the entire business as a funding mismatch.
The aircraft leasing business?
Yeah.
Yeah, well, I mean, look, going back to the days when AIG owned the biggest aircraft lessor around, it was all because they were arbitraging the cost of funds, right? They were taking AIG's supposedly awesome balance sheet to borrow really cheap on the short end and lend long. And, it works great until it doesn't. That's exactly what we're talking about, right? You need two things going against you or three things going against you at once. And all of a sudden, what looked great is suddenly a disaster.
So back to Tina, is there an alternative to equities? Have we resolved something here?
Since I raised the issue, I will say for my part, there's always been an alternative to equities because the alternative was patience. So I've held at times, both personally and in the fund, uncomfortably high levels of cash. And, I'm not saying that was always the right decision, but it was a valid, rational decision, right? You don't have to chase. If you don't find something comfortable to do, you don't have to do it. And living to fight another day and preserving at least the par notional value of your purchasing power is better than wasting it and pissing it away because you make a bad decision. So, and that's a little bit of semantics, I'll grant you, but I think that's important and worth saying. But yeah, I would say, look, even in the conventional definition of it today, with nominal yields where they are, yeah, there's definitely an alternative to stocks, and people should start weighing the opportunity cost of both holding cash and holding expensive equities for sure.
And, I'm in the same boat, so I won't say the exact same thing. But what I'd add to that is everyone should look at their cash they're holding in a bank or in their investment account. You can look across a slew of brokers. They are not paying you the true amount that you should be getting paid right now. So seek out, look for ways to find better risk-free yields than your bank's going to be giving you right now.
Yeah, that's a good point. And that's another interesting thing for bank investors out there is what are deposit betas going to look like going forward? They've always surprised me at how low and sticky deposits have been. But, this is obviously one of the concerns people have with something like Silicon Valley Bank is those deposits all flooded in. Now they might all flood out chasing better yields elsewhere, or Silicon Valley Bank's going to have to raise its deposit rates to keep or attract deposits. And it's not going to be real pretty. But I think evidence would show that people are generally a little bit lazy. There are frictional costs to moving deposits around too much. But, as you get to, the front end of the curve yielding 4 or 5%, it becomes real money.
Seriously. I think some of these companies are actually reliant on laziness. One of the largest brokers has basically all but said as much.
Oh, yeah.
And it's a critical piece of their business model, and it's a stock that's not doing so well today for the very reason that you mentioned, deposit betas. People are worried. People being investors in these companies are worried that, that game of not paying your customers what they truly deserve on their deposits, that gig is up.
Yep. And look, that's partly true of lots of things, right? It's painful to switch cell phone providers. It's painful to switch lots of things. So lots of companies are relying on that inertia, that customer laziness. But yeah, I mean, that was a very easy argument to make when it's like, oh, all right, Fed funds are hugging zero. And even if they go to 1%, nobody's going to move their money. Well, now they really might.
Yep. I remember even a decade after AOL's prime, there were still plenty of people paying AOL just because,
Yep, for sure.
Inertia is a powerful force, but we all could overcome that for ourselves, at least, not for everyone. We could find the right way to get appropriate interest on our money.
Yep.
Yeah, I mean, the obvious, drawback to holding cash is inflation, and you're basically guaranteed to lose purchasing power. Phil, do you think holding tips, there are 5-year tips out there that at least then you're sort of, guaranteeing in a way, if you take the CPI as a measure of inflation, that you're not going to trail inflation? I guess the downside is you are basically locked up for 5 years if you disregard kind of the trading aspect. And smart people should be able to perhaps find something to do in the stock market in less than 5 years. How do you look at that?
Yeah, it's an interesting question. I think it's one of the hardest questions to answer. And I think it's different for every individual. It's different for every institution, different for any fund or pooled investment vehicle of any kind, because at some level you're making an educated guess and playing chicken a little bit with what the market's going to do. Because personally, the way I've always looked at it, which I think is a rational way to do it, even if it doesn't always yield a clear black and white answer, is to assign an option value to the cash. Because to your point, even if I'm in something really liquid, when I need that cash, I have to go execute one decision to make a second decision. And I know both from fact and from personal experience and from empirical data that can throw sand in the gears when I need it the least, right? So I want to keep some level of cash available so that I don't have to make two decisions. I only need to make one. That applies both personally and in the fund. Look, our fund, I mean, we've run as low as 2 or 3% cash. So I'm not saying that I'm not, pretty much fully invested at times. We certainly have been, including recently. But I think it's also a mistake to just say, oh, this cash is a total wasting asset or whatever, because if you do deploy it opportunistically over time, which I think is the only way to do it, you should be assigning an option value to that cash. I mean, there is real quantifiable value to having that liquidity ready to go when you need it most. And so, yeah, my prevailing mantra for the last decade, call it, has been avoid duration, preserve that option value and have it ready to go. And that said, we've done okay. I wouldn't give me or us an A+ in timing that perfectly or deploying that cash in an absolutely super optimal way. But I think we've done reasonably well. And the one thing I can say we've done very well is we've completely avoided any mistakes with the cash, right? We haven't chased supposedly AAA RMBS in 2007. We haven't, taken stupid duration risk, chasing yield down the curve because we needed that return. We haven't overloaded on anything where, we were going to actually lose money. And like I said, that's goal number one.
Makes a ton of sense. How much cash is Berkshire holding these days? Do you know?
I didn't look at the most well over 100 billion for sure. And I think that's, for all intents and purposes, somewhat of a floor. I mean, I could see it going to 75 billion or something if a really massive, juicy acquisition came along. But I think there's so many other ways to raise liquidity that would be more attractive. I just don't think Buffett and Munger have any interest in ever having the cash drop to a level such that it would be, even within a million miles of an issue. So,
right.
If you held the cash through Tina, why would you get rid of it now, right?
Yeah, I mean, Berkshire has been increasing its stake in Occidental Petroleum recently. That's not a huge chunk of that 100 billion, but it's kind of interesting with this with Oxy at like $60 a share. That's up a lot from where it was a couple of years ago. And yet Buffett still finds it of value. All right. Well, thank you so much, Phil and Elliot. Great discussion. And thank you all for listening. Goodbye for now.
Thank you for listening to This Week in Intelligent Investing, brought to you exclusively by MOI Global, the research-driven membership organization. Learn more at moiglobal.com.